What's up everybody, it's Blandon here from iRefi Mortgages. Today I'm sharing with you 2 reasons why you should not reduce your loan term and what you should do instead, especially important if you're a property investor. So first of all, why do people reduce their loan term? To pay off their mortgage faster, and this is what everybody tells you to do. So here's an illustration of a normal loan, 30 years, and this is your repayment. So in the beginning you pay majority of interest and slowly you pay off your principal. So by reducing your loan term, you actually increase your repayments and you end up paying off your mortgage faster. So maybe like in 20 years. However, doing it the conventional way actually puts you at a huge disadvantage. So the first problem that you run into is that by committing to a higher repayment, it actually reduces your borrowing capacity. As you can see, your repayment for a 20-year loan term to the bank's eye is actually increased repayment. So therefore, they will take that into calculation and reduce your borrowing capacity. Now, number 2 is flexibility. So what does this mean? Now, if you need your extra cash flow, maybe something happened in the family, or maybe you have another baby, and now that you're not earning as much, the bank actually require you to reassess your whole situation. And therefore, if you're not earning as much, it's actually hard to go from 20 years back to 30 years. So this is a problem that you need to think about in the beginning. So if you don't know how servicing works, I suggest that you visit our YouTube channel to watch the Infinite Servicing Capacity video. So what should you do instead is minimize your interest costs while maximizing your flexibility. That's the position you want to be in. So here are 2 suggestions you can look at. So number 1 is offset. So instead of reducing your loan term, you can actually put your mortgage on an offset account where instead of paying down your mortgage and committing the repayments to your mortgage, you can actually let all the extra repayment go into a savings account and let it accumulate. Now in an offset account, what happens is whatever you accumulate, it actually offsets your main mortgage. So you only pay interest on the difference. This way you have more control on your cash flow, but you're still getting the same effect as paying off your mortgage faster. So if you need more explanation on what an offset or revolving credit, on how it works, check out the YouTube channel. There's a revolving credit facility video there. Second way of solving this problem is voluntarily increasing your repayment, but keeping the loan terms the same. So how does that work? You can actually keep your loan at a 30-year loan term while increase your repayment term to say a 20 years. Now, why would you do this? Because we get some clients that says, hey, Blandon, I'm not sure if I can keep my hand out of the cookie jar in this situation here where they let their savings accumulate. So this is what I suggest for them to do. Keep the loan term the same, reduce the repayment term. So you actually still pay off your mortgage in 20 years time, but what happens is you have the flexibility to extend it back to 30 years. Not all banks are going to offer this, but majority of them will, and you just got to make sure you ask when you're doing your loan structure confirmation. So if you find this helpful, but you're not too sure how to implement it, I would suggest that you apply for a free review with one of our senior advisors and take advantage of using the mortgage snapshot on our website. It takes 90 seconds. You find out exactly how much you can save, how much you can borrow, and one of our team will get in touch and to see if you can book a meeting with one of the senior advisors. So check out our 5-star reviews on Facebook as well, and visit www.irefi.co.nz for more information.